Hi, and thanks for watching In Plain English, where we're going to talk about complicated concepts in as simple terms as possible. This week we're going to talk about your credit score, what it is, what it can range to, and why it matters. So your credit score is essentially a number that is calculated by there are three different credit bureaus. There's Equifax, Experian, and TransUnion credit bureaus, and what they do is just they give you a number between 300 and 850, 300 obviously being the lowest, that helps banks or lenders or anybody. It's what it is a trust score. So it helps anybody who's about to give you some money determine how likely you are to pay that money back. So if you have a 300, it's affected by many factors, but if you have a 300, essentially that means you're telling the world that you're very unlikely to pay any money back. Whether it's because you're unable to, or you haven't in the past, or you've paid a lot of late credit card payments so they expect you're unable to. If you have an 850, then you're very likely to be a safe investment. So if they give you some money, they know they're going to get it back. So anywhere you fall on that range allows typically banks or any kind of lender, could be a landlord or anything like that, allows them to gauge how trustworthy you are in terms of the safety of their investment. So if you have a higher score, higher credit score, then typically you can get a lower interest rate because the banks don't need to charge you as much to loan you their money because they're pretty confident they're going to get it back. Versus if you have a very low credit score, your interest rates are going to be much higher because the bank wants to charge you a lot more money in order to borrow from them. So that's the basis of the credit score and what it means. Just a few factors that go into it are kind of your, say, debt to equity ratio. So how much debt do you own? How much debt do you have versus how much money do you have? So if you have a credit card that you owe $10,000 on and a car payment that you owe $15,000 on, and your annual income is $35,000, then the bank knows that if they're giving you any more money, you already owe this $25,000 total, and you barely make that in a year. So they're not going to be very likely to give you any additional money, especially a high dollar amount. Versus if you have zero credit card debt, and you've already paid off your car payment, then you're going to have your $35,000 that you could put up kind of as collateral. So they'd be willing to probably risk almost $35,000 or more on you. So you could get a loan much easier because they know that they have the potential, you have those assets to pay them back. So that's one thing. The age of your credit history is another thing that they factor in. So even if you've made every payment on time and done all that, but your average, you hold a credit card for 1 year, they're basically saying, we don't have a large enough sample size to know that you're going to pay that back. Maybe you just had a great year. So they want you to have at least a 5-year average account of history of on-time payments so that they can get a good, safer idea of how reliably you pay. If you pay pretty reliably for 5 years or more, that's going to raise your credit score because they know that you've been consistent for a long period of time. If you have 1 year or less, that's going to drop your credit score, even if you're paying well, because it's just too small of a sample size for them to be confident and in trusting you. Let's see. Another factor that can affect it could be Another factor that can affect it would be your total accounts, so how many credit accounts you have. So if you have essentially access already to 12 different lines of credit, totaling, say, $100,000, they're much less likely to give you a 13th because you already have substantial risk. So because theoretically what you could do is max out all those other cards, and your debt to equity ratio, we go back up here, would be much, much higher. So just by having those open accounts, which is why, like, if you sign up for, like your TJ Maxx card or, all those different store promotional cards, that can drop your credit a little bit, because what you're doing is allowing yourself access to additional funds to change your debt equity ratio so that you could potentially have a lot more debt without this 13th lender being able to have any control over it. So you're higher risk the more accounts that you have. Those will also incidentally lower your average age of credit. If you open up a TJ Maxx card this year and you've been paying off a credit card for 10 years, that's going to be 11 years of total credit divided by 2 accounts, which is going to knock you down to 5.5 years of average credit history. So you want to be careful with those. Sometimes they can be valuable. I'm not arguing against them, but it is something that you want to be conscious of in terms of your credit score. And the last thing that will affect it is called a hard inquiry. And so that's typically happens when you've already applied for a loan. So they want to know about that. It can happen when you go to rent an apartment, when you go to buy a car, but they want to know how many times you've asked other people for money. So the same way that you judge a person, if a friend comes to you and says, hey, I need to borrow some money, one thing you want to know is, do they already owe money to a bunch of other friends? Have they already gone and asked a bunch of other people for money? And if all those other people said no, in other words, if they're coming to you, why did all these other people say no? Do they know something you don't? So the credit unions keep track of, not the credit unions, the credit companies keep track of how many times other people have looked into your credit score. And that's why there's this idea that the number of times you check your credit score will lower your rate. And that's not entirely true. You can check your credit score fairly often, and there are free sites now like Free Credit Report or Credit Karma or that really you can check it almost all the time and it won't hurt your score. It's when other lenders check it that they want to be interested, because it's a question for them of, again, why did you ask that lender for money, and why did that lender either say yes or say no? And that all combined is how they come up with this number, and they have, I'm sure, algorithms that I don't know, but you're going to get some kind of trustworthy score between 300 and 850. And that, again, dictates to them, to any other future lenders, how confident they can be that they're going to get their money back from you. So it's going to affect interest rates, it's going to affect ability to get a credit card, ability to get a mortgage, ability. Anytime you're asking somebody for money, they're going to look at this score and see how trusted you are by other people based on your history. So you want to try to keep that as high as possible, maintain it, make sure that there's this is one of the biggest problems with identity theft, is that you can build up a huge credit card debt and it can really tank your credit score and really hurt you. Or you can have late payments that you don't know about or whatever. So you want to keep track of those things to make sure that there's nothing in your credit history, your past credit, that's going to affect this score to make you seem less trusted to your future lenders. So that's your credit score and why it's important in plain English. I appreciate you watching. Thanks. Please remember to like, comment, and subscribe.